Well, moving on from there, it's been the RBI, and that's been the star of the street as well over the last couple of weeks. What we believe is that the RBI has announced a fourth buyback to the tune of 40,000 crores of government bonds due to the ample cash reserves which they've been sitting on. Mimantsa is joining us with more detail on this. Mimantsa, we've already seen 3 buybacks, and they weren't successful, to say the least. But of course, the RBI is not quitting. They've come out with a fourth buyback this time, and that too to the tune of 40,000 crores, despite a tepid response. What has prompted this buyback to begin with?
So yes, Amina, the purpose of buyback is, of course, to inject liquidity, and liquidity had been in deficit for the longest time. But the core liquidity, or the frictional liquidity as we call it, which is measured by the government's cash balances, that had been in surplus. And add to that the dividend transfer that came in from the government, came in from the RBI of 2.1 lakh crore rupees, that had actually ballooned the cash balances that the government has. And since it's an election time, cash balances are in fact much higher than what they had been in the last 2 Lok Sabha elections. So since election time, there's a model code of conduct. The government cannot spend this money. So they want to maximize the returns on these cash balances. So that is why they have come up with the buyback operations. And what we get to know from our conversations with bond market traders is that they are thinking probably the government wants to redeem the government securities that were due for maturity this year. Earlier, the last 3 buybacks had a bond mix of ones that were maturing next year in January, February. But in the last 2 buybacks, we have seen that the bond mix has been changed, and they are expecting a better response to come in if the maturity of these bonds is a little shorter. So they have come up with June, July bonds and November. So that is what the government thinking is right now.
So, Mimantsa, out of the 1.6 lakh crore worth of bonds that were offered for repurchase, the RBI only accepted bids amounting to 11%, so 18,000 odd crores. Why did this response fall short? I mean, if this is to infuse liquidity, what are we missing here?
So liquidity, of course, buyback, the purpose of buyback is to ensure liquidity. But RBI has also been doing its variable rate repo auctions, which
happen at the start of the month.
Right. They happen
frequently.
Yeah, frequently, as and when the requirement arises. So on liquidity front, things are not that difficult. Right. So that is why, and also banks who are holding these bonds, they are holding it in their HTM portfolio, which is the held to maturity portfolio. So they would not want to, they would not want to sell those bonds before maturity. Yes, and they would want to wait for the election results, and we have JP Morgan bond index inclusion money that will flow in. So they would want to keep those portfolios.
So anticipation is that yields will improve and there will be M2M gains after a very, very tough run for the debt market, right?
Right. Samina, there's one more interesting point here. RBI has a dual objective. They are also the government's debt manager, and they are also the monetary policy regulator. So they have to ensure that the rates, there's no sort of signal to the market that the rates are going to fall, and they have to also ensure that the government's borrowing costs are lower. So pricing is an issue, is what we understand. The price at which banks had bought these securities 10 years ago or whenever, those were higher, and now they don't want to sell it as at a loss. So that is why the response that we have been seeing is not that that's
so
important.
This is the 4th buyback where the response is more than likely going to be tepid, given the precedents that we've had of the last 3. Well, that's, of course, a very interesting piece of data that Mimantsa brought us.